The rise and fall of cryptocurrencies in the last 2 years has been well documented, from an all-time high in November of 2021 when the top 100 cryptocurrencies represented a $2.7 trillion market cap to where it currently stands now at $1.1 trillion, over a 60% haircut in that time frame. Rocked by scandals and frauds, what was once heralded as sort of a liberating new digital asset has left many people wondering, what was the actual value proposition behind these assets again? And how is it that they're worth so much? You don't have to look far to see countless tales of grifters and con men promoting garbage cryptocurrency as if it were the next coming of gold in digitized format. The term pump and dump has become synonymous with any small tier promoted crypto project, and there have been many great videos on this YouTube platform exposing crypto frauds and these questionable business practices. Now all this has left me wondering why. Why is crypto such a ripe breeding ground for con men and frauds? As a part-time economist, I wanted to examine the market structure to see if we could find the answer to that very question. The first important characteristic of the cryptocurrency markets is that it has a low barrier to entry. Now, that means any number of different people can create their own crypto project or NFT project and get that off the ground running with relatively low startup costs. When researching for this video, I found that it could cost anywhere from just a few dollars to a couple of $100s to set up your own cryptocurrency or NFT project. The second key characteristic to being a low barrier market is that there are no major variable costs. There's no material costs for producing cryptocurrency. Everything is a digital product, which means that there's no storage costs, no shipping fees, or anything like that that would be dealt with on a physical product. Additionally, it requires very little effort to make. When researching this again, I saw that you could set up your cryptocurrency in minutes to maybe a couple of hours. So all of these factors that really set up this low barrier make it very attractive to these grifters. There's low costs, low risk, and very high reward if they can get buy-in from a group of investors into the project. The second reason that fraudsters are attracted to these crypto projects is due to the complex nature of the product. Cryptocurrencies are a really hard to evaluate asset. There is no business behind them. They have no real intrinsic value. There's no financial statements you can evaluate. They're based largely on speculation and promises towards vague technologies in the future. This really creates something that we call in economics a asymmetric information problem. And that means that the creator of the project holds all the information about what sort of value lies behind it. And in the case of these con men, there is no value. The con man also controls the initial formation of the coin or the project, which means that they can create this sort of large stockpile of coins and sit on a large chunk of them. And then when value is added into the market by people buying in, they can sell off that large portion of holdings that they're sitting on and take out the cash, aka the rug pull. Cryptocurrency, blockchain technology, and non-fungible tokens are kind of these buzzwords with really sort of opaque understanding around them. Most people have very little idea about what is the inner workings of this technology. But these are digital assets often being promoted on digital platforms through social media and other things. A lot of people want to be seen as smart. They want to be seen as getting it and technologically savvy, even if they think the blockchain is a series of connected Lego bricks. Now, grifters really rely heavily on these bandwagon effects and conformity bias. People like being a part of the in crowd. They like getting it. And they also don't like looking stupid. So they buy in with a lack of understanding or any due diligence about the investments that they're trying to make. And they do so because they see the crowd also doing that. And they think if everyone else is doing it, then it must be smart. It must be a good way to make money, so they're hopping on the bandwagon. And this leads us to the third key characteristic, which is what really crypto grifts are using to invoke the bandwagon effect, and that is the idea of building up hype. While cryptocurrency can be a complex instrument to evaluate and understand, hitting the like button is a quite simple and easy idea to execute. Also consider subscribing to the channel if you want to see what other economic topics I cover in the future. Hype is a psychological concept that refers to the enthusiasm, exaggerated promotion, or excitement surrounding a particular product, idea, event, phenomenon, things like that. It involves creating a sense of anticipation and buzz to generate widespread interest and attention to the idea at hand. Hype can be seen as a persuasive tactic that influences people's perceptions, emotions, and behaviors. It taps into our cognitive thinking and emotional feelings to create a sense of urgency, exclusivity, and desirability. The psychological definition of hype often involves the following elements. Number 1, exaggeration. Hype typically involves exaggerating the positive aspects or potential benefits of a product, in this case crypto, and this exaggeration aims to capture attention and generate heightened interest around the product or idea. Looking at Logan Paul's Crypto Zoo project, it's easy enough to see how many of the claims he made about the game he was developing were greatly over-exaggerated on what was actually delivered to the investors at the end of the project. It's easy to see these crypto projects to promise a lot and ultimately return little for most of these investors, and in a lot of cases they lose everything. Secondly, hype often leverages social influence by showcasing the enthusiasm and the endorsement of influential individuals or groups. People may be more inclined to adopt or participate in something if they perceive that others, especially those that they admire or consider experts, are doing the same. A lot of these crypto projects are masters of using these influencers and celebrities to promote the different projects. You see DJ Khaled, Kim Kardashian, Floyd Mayweather Jr., Matt Damon, all promoting different crypto-related products. And it's going to have an influencing effect on people, even though that these celebrities are not crypto experts by any means of the imagination. They just implicitly trust the influencer because most people want to envision having a life like that influencer. And if they are promoting the project, then that must be a way that that person could become more like the celebrity they are admiring. Thirdly, hype frequently targets emotions, seeking to evoke excitement, anticipation, or a sense of belonging in individuals. It plays on an individual's desires for novelty, exclusivity, or a sense of being part of something significant or trendy. Novelty is a big factor in these crypto projects. Crypto has been spun as the hot new investment. Of course, that is going to play on people's emotions to want to jump in. And this plays on our needs to conform and hop on the bandwagon. Fourthly, hype can utilize scarcity and fear of missing out effect. Creating a sense of scarcity or limit availability can amplify hype by suggesting that the product, event, or opportunity is rare or limited timed. In the case of crypto, you want to get in early before the price skyrockets because you want to be the one who sees those massive investment gains. This early buy-in from a lot of people ends up boosting the value of that cryptocurrency, which sets the con man up for the classic pump and dump. The con man owns a massive amount of coin reserves, and once the value of the crypto coin hits a certain level, they sell off their holdings and walk away with real cash, leaving the marketplace saturated with this worthless coin that they were promoting as the next hot thing. We'd all love to get rich quick, and some of these crypto projects seem to offer that possibility. Who doesn't want to ride their trash coin to the moon? And we see these small values have really big percent swings. And when you see something jump by 1,000%, then a lot of people buy into the hype and they want to invest too. All of this is really to say that lastly, hype can influence how people perceive a particular offering or situation. It shapes our expectations, framing the experience often in a positive light and potentially leading to biased judgments or overestimations. In the case of a lot of these crypto projects, unfortunately, that is catastrophic to the investors as they wind up losing all of their investment in whatever they thought might be the next hot thing. So when it comes to the crypto markets, hype is a prime factor in fostering the fraud. People become blind to the fundamentals of the asset's value proposition, and they make misguided investment choices. It is what lets these projects reach levels where the inevitable fall is a big one as the grifter walks away with large chunks of money. Which leads us to our final characteristic on why the crypto markets are ripe for fraud. The last major factor is really the lack of regulation and due diligence on these cryptocurrency assets. For the past decade, there has been poor governance around cryptocurrencies in the US. Debates have raged about whether it is a security falling under the purview of the Securities Exchange Commission, or are they a commodity falling under the Commodity Futures Trading Commission, or are they something completely different? Regulatory authorities don't seem to wish to stick their necks out and make definitive answers. When you enter into the fray of a $1 trillion market, they are going to get mired down really quickly by vested interests on both sides. But I think this is absolute cowardice not to step in. These regulatory bodies need to make definitive rules, and when they don't, you get massive negligence like the FTX scandal that rocked the news in late 2022. There is no bank or other centralized authority to flag suspicious transactions and attempt to stop fraud before it happens. Crypto transfers can't be reversed. Once the money's gone, there's no getting it back. There is also a severe lack of disclosures and ratings around these cryptocurrencies. When you look at a publicly traded company, they make regular filings with the SEC. When you look at fixed income securities, they are issued credit ratings by different agencies. All of these tools let the investor evaluate the asset to see what it's worth. Cryptocurrency really lacks that. Additionally, there's a lack of regulated exchanges, which allows anyone to play and post their investment opportunities for anyone to come and buy into. And this really leaves the consumer or investor at a massive disadvantage, especially when it comes to consumer protection. The government has seemed to start to catch up and pay more interest in cryptocurrency. The IRS is definitely happy to tax your crypto assets, and we have been seeing more influencers being charged in crypto scams, or more specifically, not really stating that they are being paid to promote these different crypto projects. We saw the SEC settle with Kim Kardashian for $1 million. Sam Bankman-Fried has been arrested for fraud, money laundering, and campaign finance offenses, all due to his FTX company. And a bunch of other influencers are getting charged for not disclosing payments to endorse crypto projects. So when you combine these four main characteristics, low barriers to entry, a relatively complex product, significant hype built around that product, and a lack of regulation, it just becomes a ripe breeding ground for grifters and con men to come in and take people's money. If you found this video on cryptocurrency markets interesting, consider checking out my video on why the commercial real estate market is facing its own problems on the screen now. Thanks for watching. We'll see you in the next one.